Okay, folks, welcome to an emergency Thursday night stock charts live. Okay, so the theme of tonight's show is going to be today's lows may be tomorrow's highs. Think about it. Today's lows could be tomorrow's highs. So when we enter a bear market, which we entered weeks ago, some people use the uh, definition of 20% down from the highs as being a bear market. I say, why bother? If you see it coming on the charts, just call it what it is. It's a bear market. You're going into one and buckle up. And we've been talking about the probability of what we are seeing for the past several weeks for nearly 2 years. We've been watching the yield curve. We haven't always been short. We've been long, but saying, get ready to pull the plug on this market. And it's beginning to unravel. It was an overbought market, expensive market, looking for a reason to pop, and it has found it. So today, a broad-based sell-off across the board, with the exception of a couple of sectors, one of which we are very long of, which is bonds. And if you were a viewer of this show, you would have known for a while now that there are certain sectors that do very well in this environment. We'll talk about them in a moment. So let me say hello to folks. I don't want to be rude. Make sure my audio is good. Hey, Tim, you're very welcome, pal. You're very welcome. Yeah, one of our members, Talon, said, you know what, maybe you ought to do a Thursday night stock charts live, even if it's abbreviated. It's going to be abbreviated tonight. So let's talk about the markets. Let's talk about the whys behind what's going on. And we will talk about where I think that we're going. And right now, my mind is not on what's happening right now. It's where am I going to invest my capital when the bottom is put in? And we'll talk a little bit about what a bottom will look like and how you'll know when the bottom is being put in. So we have a lot to go over. So let's get to it. Hey, Sean. Hey, brother. Welcome. So first, I want to begin with a shout out to our sponsors, TrendSpider, the sponsoring tonight's show. Head on over. They have great software to trade a market like this. And in fact, I'll be talking about one of their indicators that will help you identify when a bottom is in the market. So head on over, 35% discount code below on YouTube, above on Twitter. I'll copy the link in. Actually, the link is below. So head on over, take a tour over at TrendSpider. They have a bunch of great stuff here. Fundamental analysis, technical analysis. I call it the poor man's Bloomberg terminal. So a lot of good stuff here. So head on over, buckle up, and let's get to where we're at right now. We spoke about this on Sunday night. Where are we now? And what you're looking at is the takeoff from a bear market. And this is when people don't believe that the sell-off is over. They're so shell-shocked that they can't believe that it's safe to go back in the water. And that's what they call a wall of worry. Then you get a sell-off. And people believe, aha, we were right. We were right. You shouldn't have gone back in. They hunker down even more. And then all of a sudden, the market just begins to rip up higher. And all through this, up until about here, the retail investor stays out of the market unless, of course, you're dollar cost averaging. And if you have a 20, 30-year time horizon, there's no reason why you should not be dollar cost averaging in right now. Your time horizon is, you got plenty of time. Keep doing what you're doing. Consult your financial advisor. So you enter the new paradigm. What does that mean, new paradigm? That means that it's different this time. We have AI, we have quantum computing, How much have we heard about this over the past 3, 4 years? And we were never going to go down again. Here we are. So we had our rollover. We have recently rallied back. And now we have taken out prior lows. So that return to normal is all but gone now. And now fear is beginning to creep in. I've been warning, if you've been on more margin, get off of margin, because what you're going to see over the course of the next, I don't know how long it's going to take. Could be a couple of months, could be a couple of weeks. I don't know. I'm not that smart. But over the course of the next uh, short-term time frame, you're going to see what you call forced liquidation. What's happening right now is that you have brokerages. They're sitting in their conference rooms and they're saying, okay, here is a tranche of stocks. Here are a tranche of ETFs that are currently, let's say, 30% marginable. All right, you only need 30% on the dollar to buy those stocks. Well, they're going to take a segment of those and they're going to go up to 35, 40. So even if you didn't have a margin call tonight, you could wake up tomorrow morning with a margin call. Why? It's because the margin requirements have increased. Your broker's saying, hey, you got to pony up more capital. You are in a new environment. The bull market is over. We were willing to finance this. We are not looking to be financing this. So if you're on margin, consult your financial advisor, but consider getting out, because you are not the senior partner when you are on margin. You are the junior partner, even though it's your account and your capital. So at some point in time, you're going to get despair. And how I phrase that to members, how I let them know that you're in despair. It's not just a feeling of, well, I can't believe my portfolio, I was going to retire, now I can't retire, blah, 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 blah. It's not that. It's when you get down day like you saw today, and you're like, good grief, there's no way this stock market can go any lower. And then all of a sudden, it gaps down again. The futures are probably going to be bright green tomorrow. If you go buying those bright green futures, you're out of your mind, because this was not the bottom. Could we rally off of, let's call it 460 on the triple Qs, which is around where we closed today? That was my price target for the triple Qs in early March. We bottomed at 470. I covered shorts because I could see there was a bid below, and I covered my shorts. So I did not cover my bonds, though, and I'm glad I didn't. So now we have taken out the prior lows, and now we are at my former price target. But now that price target is moved, because what I was using was a weekly chart. And we have a downtrend channel. I'm going to go to that chart in a moment. We have a downtrend channel on a weekly time frame. Here, let's just go bring it up right now. Here you have it. Let's take the automated trend lines off, auto fibs off, and here you have it. This is not the AI drawing these lines. This is me. So I drew these lines, I don't know how long ago, but a while ago. And the upper band of resistance was tested here the week of March the 24th, and it has failed. And now we've broken down. And we are probably going to move down to, let's bring up the fibs. They don't have any lines there. We're probably going to move down to around, I said 440 earlier. I think we're going even lower when all is said and done. I think we're pulling back all the way down here to around 433 on the triple Qs. We closed out the day at what? I think I said 450. Yeah, around 450. So that's a measurable ways away to go before we see a bottom. So what does that bottom look like? Well, here's the day today, right? They rally it and it gets rejected. Rally gets rejected. This is all a sign that you have a tremendous amount of sellers above. This volume today was not that impressive. The Qs were down around 5% on the day, and volume wasn't even double the average. So what that tells me is that you still don't have capitulation. So one day you're going to wake up and you need to really know your support levels. That's why I strongly suggest you have your charting software and you understand where your support levels are, and do not buy until they are tested. You get probably an overshoot to the downside, and then you get a bullish key reversal. I just threw a lot at you. So what that day is going to look like is you're going to wake up and you're not going to get green futures like we're going to get tomorrow morning. If you get green futures tomorrow morning, they're trying to lure you in. They're trying to get you to buy stocks thinking that, wow, the bottom's in. Tom Lee was just on CNBC. That guy's great. He just said S&P is going to close up on the year by 10%. I got to get in now. Okay. But that's the game. Traditionally, you are not going to get a bottom when you get bright green futures. Bright green futures beget selling, just like you had today. You gap lower, rallied, rejection. Yesterday, rally, rejection. Expect that. That's the type of price action that is what you call continuation breakdown price action. So be very, very careful. I just said today, this is a weekly chart. These are weekly charts. So on the week, they rally you and you get rejected. And the reason why I'm using a weekly chart is that if you're using a daily chart right now, if you're using, God forbid, you're a day trader and you're using 15-minute charts or intraday charts, that's crazy. That's crazy. Don't do that. You should be looking at bare minimum weekly charts to identify where your historical support levels are. That homework should be done right now, just like I have them here. And in fact, I see another opportunity as a support level right here at 412. So the morning that the bottom is put in, we're going to go back to despair for a moment. You're going to wake up and you're going to say, oh my God. And you're going to see the futures redder than red, like you can't believe. But if you remember, to the contrarian trader, you're going to know the support levels at which you should be buying stocks. You should have your capital at the ready, and you need to be able to step into the breach, meaning you need to be able to say, hold your nose, ignore the sickness that's in your gut, that you can't believe the stock market's going lower again, this big. How is it possible? On that day, you need to step into the breach and begin to buy stocks. But you can only do that at historical support levels. We're not there yet. And we certainly do not have blood in the streets. So what's the catalyst for what is going on? The catalyst for what is going on is, yes, tariffs. Yes, trade wars. But the other thing is that you hear crickets. What do I mean by that? Normally on a down day like this, you know all those Fed governors we talk about on Sunday night, they're going to be giving speeches during the week. They're always giving speeches. What happened? Where are the speeches today? No speeches. On a big down day today, crickets. You heard nothing out of the Federal Reserve. So after today's price action, What are the probabilities of the Federal Reserve coming to the rescue? For May, still only 32%. It's a big upward move versus yesterday, I'll tell you that. That's a big change, almost double. June is now at 82. But the market's not going to wait here for the Federal Reserve to cut rates. No, no, no. The market is going to demand that the Federal Reserve cut rates. How do they do that? They do that by dropping lower. The Federal Reserve doesn't care about the stock market. A lot of people believe that the Federal Reserve cares about the stock market. They don't. They really don't care. They care about the bond market. The bond market is vastly larger than the stock market. They care about orderly markets. They want an orderly pullback in the stock market. Once the wheels start coming off and people start questioning our society and the way we're going to live in the future, and you get layoffs and you get these bankruptcies and you get high yield debt beginning to roll over as it is now. Here, what did high yield debt do today? High yield debt is what you call junk bonds. High yield debt tanked today by over a percentage point. That's a big move. This is a weekly chart. It's down on the week. Sorry, I keep thinking about the daily chart. We're down 1% on the week, but it's not about how down we are at current. It's about the pattern. What do I got here? I want to get these things off. Driving me crazy. Why can't I take this off? All right. So it's about the pattern. What is this? There we go. It was the auto fibs. Okay. So what you're looking at is not just the junk bond market, which is declining by a percentage point. What you're looking at here is very similar to what you saw on the triple Qs. It's a downtrend channel. Here's your double top. Here is a break of prior support. The junk bond market today just went into a new downtrend. That is what the Federal Reserve cares about, the bond market. Junk bonds finance companies that probably shouldn't be in business. That's why they have high yields. So these companies, if the price of junk bonds are dropping, that means yields are rising and they can't afford it. So the Federal Reserve is paying attention to that. Now, on Sunday, we spoke about the reasons why Donald Trump wants the stock market to go lower. The reason is he wants to force the Federal Reserve's hand because we have $7 trillion worth of debt that needs to get refinanced this year. And it was taken out at near 0%. The 10-year yield is at about 4% right now. That's a big increase in outlays for interest on our debt. We can't afford it. We're broke. And we're about to refinance at higher prices. So Donald Trump, if you're wondering what he did last night, it was completely intentional. He knew exactly what he was going to do. So the Federal Reserve has done nothing, as they really should have. They shouldn't be doing anything. There was no reason for them to cut rates back in September. There's no reason for them to cut rates right now. But what he's doing is he's jawboning the Federal Reserve into action. And the way we measure that action is by taking a look at the Fed Watch tool, because the Fed Watch tool told the markets back in September, hey, he's going to cut. Even though I said there's no reason for him to cut, he cut by a half basis point. So He wants to jawbone the Federal Reserve at the May meeting into cutting rates, even if that cut comes on a Sunday night before that meeting. So this is big balls power play going on here. You do not want to get in front of this Mack truck. So understand the macro, what's going on here. Trump wants a weaker US dollar. Why? The weaker US dollar makes our exports cheaper overseas. So it helps our domestic industry. And he wants lower bond yields to help refinance the debt. Simple as that. So what's Jay Powell going to do here? Jay Powell is going to have to eat crow. And I've said this before, and I think that this is what is going to happen. He is going to, this is updated for today. This is the Fed's balance sheet. The Fed's balance sheet has been in a major decline, as it should be, as he should be doing. I am not knocking Jay Powell. It is moving lower, rolling off debt off their balance sheet. The problem is the rolling off of debt off of their balance sheet increases interest rates. They were buyers of debt back here. That kept interest rates low. Remember, 0%, 0.1%, refis, just cheap credit to buy stuff that's now probably in a junkyard. So now we are doing the exact opposite. He's putting pressure on bond yields to stay up. Trump doesn't want that. So Jay Powell knows inflation is still out there. So what's he going to do? What's he going to do? What I think he's going to do is that he's going to go into the bond market, and initially he's going to stop rolling off this debt. He didn't do it last week. I wish I could come on here and say, I told you a couple of weeks ago that he was going to do this. He didn't do it last week. So we're still waiting for Jay Powell to respond. You've heard nothing from him. Now, over the course of the next several weeks, however long this correction lasts, you're going to see ruthless bear market rallies. You're going to see rallies that you're going to instantly think, you know what, the bottom has got to be in here. I got to buy stocks. Be very, very careful. Those rip your face off rallies, as I like to call them, because the shorts get their faces ripped off. If you buy them and you don't know when to get out, if you don't know where your upper band of resistance is on your chart or where your horizontal resistance levels are, where it's logical you should book profits, well, then you can get easily wiped out very, very quickly. So when we know that we are in a market that is near capitulation, you take a look at the VIX, which is what you call the fear index. And back in 2008, when you had the financial crisis, we had a high of 89.53. Back here in 2000, we had a high of 45. That was nothing compared to financial crisis. The financial crisis, we came very close to eclipsing back in 2000. This is what the VIX looks like at a capitulation bottom in equities. S&P 500 trades inversely of the VIX. So here, we'll do this. Let's overlay the S&P 500 above. And here you have it. All right, so here's the S&P 500. You peek out on the VIX, S&P goes up higher. Back here, 45, S&P, that was actually a higher low, moves up higher. Back here, 2000, we hit a peak, which not so coincidentally, I think I had this set for a 7 standard deviation Bollinger Band move. Yeah, You hear me talk about a 2 standard, a 3 standard, a 4 standard deviation Bollinger Band. For a stock market bottom, I use a 7 standard deviation Bollinger Band. That is how bananas the VIX gets. So right now, we're only right here. We're at what, 30? We just crossed 30 today. So be careful. There's a long way to go before you get capitulation. Now, this can come really, really quick, really quick. So it's key. Stay off margin. If you have cash, wait for that capitulation day. If you're young, 20 years, 30 years left to go before you need the money, dollar cost average. This is your opportunity. Are stocks cheap? No, we're still sitting with a PE multiple of 33.52. And earnings are expected to decline this quarter. So even if we trade flat for the next 6 weeks, as earnings roll out, this could actually move up, even though stocks are flat. Why? It's because the earnings growth of the S&P 500 and the revenue growth are expected to decline. Things to watch out for. I've gone over this chart, the yield curve, for about easily a year and a half, probably 2 years. And I've talked about the inverted yield curve. That's when the 2-year Treasury bond yields more than the 10-year. That's not supposed to happen. That's the stock market or the bond market saying there's something wrong here. There's something very, very wrong here. And the only reason why this didn't unravel a lot sooner is that you had Biden's Treasury Secretary financing the bull market in stocks. She was just sending out money out of their general account fund. It wasn't Jay Powell. It was the Treasury Secretary, a slush fund. But that's done now. It's over. So now we've entered the red zone. We've talked about the entering of this red zone for months. And now we are getting ready to rip up higher. So how is it playing out? The predictions over the past year and a half, 2 years. S&P 500 rolled over. Gold skyrocketed. Pulled back today, probably going to pull back further, but still in a bull market. That includes silver. Natty gas. We've been long of natural gas. We've done very, very well with natural gas. Why? Because we knew that it did well in this environment. We're still long of gold, still long of silver, because we know it does well in this environment. I got hurt today in oil a bit. We don't have a huge position there, but it was ready to break out. It failed. I think that oil is going to probably pull back further and then going to move up higher. This is the market that we have, folks. It's not the one that we want. So if you're thinking about taking a capital and putting it all to work because we had a 5% dip in the triple Qs today, you want to rethink that strategy really carefully. I went into ChatGPT because I had very short notice on tonight's show. And let's go to comments. Let's say hello to folks. And if I could ask you guys to like, subscribe, you know the deal. Polish Taco, great photos from Poland. Thanks for sharing. Bonnie Bean, hello. George, hello. Talon, welcome. We're here tonight because of Talon's suggestion. TZ Burton, tariffs are here, no doubt. Larry, S&P 5160 probably won't hold. Next stop would be support at 4680. Sounds right to me. Indices down nearly 5% and VIX hit 30. Yep. And it's probably going up higher. So I posted in ChatGPT because now we're thinking forward, right? We're thinking about, right now, I'm thinking about a rally and I want to add to shorts. I want to get short. But we're thinking further down the line. We're looking at that capitulation. It's like a diamond jig to a barracuda. We want that capitulation. So What do we do when we get that capitulation? How are we going to allocate a portfolio of $100,000 for maximum return over the next 12 months? 25% in small caps. Why? Yields are low, valuations are low, and they love cheap money. So the small caps, the growth engine of our economy, tend to recover quickly, and they can double within the first 12 months. Technology and the Qs. Why? Lots of volatility. Funds love them. They're liquid. They're a go-to. Got to have them. Consumer discretionary. Right now, the consumer's dead. Mortgage delinquencies rising. Car loan delinquencies rising. So earnings are up, but they're not spending. Therefore, they're paying down debt. They're doing the right thing. But they have no money right now to go spending. So you wait. Smaller allotment. Banks. I would even go more than 10% on the banks because of deregulation. I don't think they've calculated that in here. Energy, no doubt. We've already begun to build a position in energy. Copper. Why? Dr. Copper, as they call it, global demand, industrial growth. If you believe in the reindustrialization of America, as I do, then you need copper. Not now, but soon. Gold and silver, stay small there. Right now, you're seeing the growth spurt in those names. They're probably going to peter out after the stock market rolls over because right now, those are a go-to as a safe haven. But money's going to come out of that safe haven once people realize it's time to get back into stocks, especially fund managers. Now, how do we know that we have a capitulation? I kind of already went over it. That's from my experience. But if you want to use past bull markets, as I queried ChatGPT, signal when the strongest stocks get flushed out along with garbage, it often signals forced liquidation, similar to today, but worse. Huge down volume days on the S&P 500 triple Qs. Today was a big down volume day. It wasn't huge. VIX above 35 or 40. That's way too low. Way too low. It needs to be above 50 or 60. Put call ratio above 1.2. Selling into close, liquidation, followed by gaps up. That is wrong. That is not what you see. Usually what you get, again, is that down market, a big down day, and then a bullish key reversal bar. Then you'll get a follow through for a couple of days, maybe a couple of weeks. And then all of a sudden you start rolling over again and people are like, it's here again. The bear market's back, another bull trap. But then all of a sudden you put in a higher low. And then this occurs. You have a big down day, and all of a sudden you gap up. And then when you take out that recent prior high, you're going to see more fund money, computerized money just dump into the market. And you're going to be shocked by how fast the market moves up higher. You got to be ready. Really, really ready. Other indicators out there are going to be the AAI sentiment survey, bullish near or below 20%. Yes, be careful there because you're going to see posts like, I had it up here earlier. I must have lost it, where they're publishing a lot of these fear and greed indexes. Folks, just like some stock charting indexes or indicators can stay overbought or oversold, so can these indices or these surveys or indexes. So be careful about the fear and greed index, which was at really fearful levels in early March, and it worked out. It rallied, but then it failed, right? You don't want to get lured into a bull trap. You need that capitulation sell-off in stocks. You need reasonable valuations in stocks. We're not there yet. And I would also add that you need intervention by the Federal Reserve. And what would help is a very strong jobs and GDP number indicating that you are getting growth in the industrial base of the United States. If that happens and stocks are cheap or reasonably priced, equities are just going to have a rip your face off rally. It's going to be a huge new bull market. Let's go to comments. Like, oh, I think Pfizer is the best. All right, Pfizer, I do not condone at all. Atrocities. I'm worried about them being sued for atrocities against humanity. And that's pretty much it, folks. Just be careful out there. Again, here's the fear index. We're just nearing the precipice of being, quote unquote, overbought. So everybody, thanks for joining in. Have a profitable trading week, or at least have a safe trading week. There's no shame in sitting in cash or being in bonds. My largest position right now is bonds. And what did they do today? Ugh. Bonds are up on the week and on the day. How did we know to put our capital? My largest position is right here. How did I know to put my capital there? History. History has shown us where you need to be in this type of environment. So head on over, take advantage of our 14-day free trial offer. I give away TrendSpider for free to our silver and gold level members. If you're not ready, that's cool. I'm all good with that. Take advantage of TrendSpider's 35% discount code, minimum 35%. Use the link below on YouTube, link above on Twitter. Everybody be safe. Talk to you soon. Be well.